This is the Building Wealth Podcast with your host, Stephen P. Sitkowski.
Well, welcome everybody. Stephen Sitkowski here. This is my Building Wealth podcast. Glad to have you back. This podcast is really picking up a whole lot of traction. If you know some other people that you think could benefit from better understanding what's happening in the markets and being able to identify opportunity, appreciate it. And if you'd kind of share the news, obviously, no pressure. We have just begun moving into June. Is that remarkable? It's remarkable to me. Just, the way that time moves, pretty incredible. I just wrapped up a 3-day mastermind summit that I did in Vegas along with my partner. We do this once a year. We had about 100 people out for it. And it was pretty remarkable. The number of people that came up and talked about how their lives have been changed. And, you know, I've been working with people and their money now for 45 years and been teaching for almost all of that. I've had a chance to work with somewhere between 1.5 and 2 million people. And, it takes a lot of effort, a lot of diligence. And every now and then I think, is it time to hang it up? And then I get with the people that have been in classes that I've done that have completely transformed their lives, their attitudes, their energy as a consequence. And it is such an honor to have influence on people. So every time I think, maybe I've done enough, then I start thinking, I've just began. So for those of you that would like to submit questions or topics, feel free. You can send me an email at stevesitkowski@gmail.com, and I will include it as a part of the program. So there you go. A little bit of my background. Lucky enough to get a scholarship to the University of Southern California, ran a $2 billion brokerage firm, had all the licenses, was president of two different financial planning organizations, author, lecturer, and that's too much about me. Quick reminder that what we do here is for educational purposes only. It is not intended as investment advice. Although I may share with you some things that I think are particularly strategic, but I'm not telling any of you run out and buy this stock or, hey, I put this trade on, so you should put that trade on, right? Everybody's situation, of course, is a bit different. So, what is moving the markets? The markets have continued to advance in spite of what I think are some pretty detrimental headlines. First of all, Iran has stopped talking to the US. And, it's just so interesting the dialogue that comes out of the White House. And I realize in today's world, nobody really seems to be able to talk about the administration unemotionally, except for me, because I just don't give it any emotion. But certainly I need to pay attention. But I find it fascinating that one day we're making great progress, supposedly, with Iran. Looks like we have a deal in the works. We've extended the ceasefire. Everything is great. Oil prices come down, right? The market believes, the oil community believes. And then next thing you hear is all bets are off. And Trump today said he doesn't care that negotiations have terminated with Iran. Now, I think he just says that. Wouldn't he have to care? Wouldn't he have to care about the fact that he can't get the Strait of Hormuz open? Wouldn't he have to care about the fact that oil's trading for over $90 a barrel? I hope he cares. And I hope him saying he doesn't care is just, maybe him being defensive. I could live with that. I couldn't live with him not caring. That's a whole different deal. So we'll see what happens. Every week I talk to you, and most of the time, because he has just said something that indicates that we might have an agreement in place, thing blows up, but that is the latest and greatest. So that's not particularly good news, is it? And yet, the markets didn't tank today. Nvidia earlier in the day was up 5%. I think it finished even better than that. This is my personal largest holding. So that made for a nice day for me. Hope you had a good day. Hope you own Nvidia. I mean, if you're an investor and don't own Nvidia, what were you thinking? I mean, this is the gateway to AI, and AI is what's driving the market and going to continue to be the market driver for at least the next 5 years, probably beyond. How could one not own Nvidia? But anyway, they've come out with some new super chip for PCs. And all of that looks good. I think they're doing some kind of a joint venture with Microsoft, but Nvidia stock, really nice. We'll pull up a heat map and we'll look at how various stocks performed on the day. Anthropic has filed their paperwork with the SEC to get permission to go public. When that will happen, they have not announced yet. That'll probably be another, along with SpaceX and along with potentially OpenAI, probably another $1 trillion IPO. I was talking to my class this week, and I told them, I remember when $1 million was a lot of money, and then it was a billion. Now, if it doesn't start with a T, it doesn't seem to have anybody's attention. The 10-year Treasury, pretty steady at 4.469, which is a little surprising given the fact that we have stopped talking to Iran, that oil prices moved up again. And I would have thought that the 10-year would have jumped, moved up slightly, but it was ever so slightly. And oil prices, they were in the 80s. Now they're back up over 90. I think they were up 5, 6%. They were up about as much as Nvidia stock. One is good news, and the other, of course, being a bad news, that with oil prices. I was just driving back from Vegas and filled. I've got a small SUV um, that likes gas. It's about a 500 horsepower SUV, and yeah, it was $105 to fill the tank. So this was last week's market breath. So let's kind of dissect this a little bit. Um, Two key things that personally I look at. First of all, we have the New York Stock Exchange on the left. We have the NASDAQ on the right. So I look at advancers versus decliners. So on the NYSE, 1,632 stocks went higher compared to 1,195 that went lower. That's great. And then I look at number of new 52-week highs versus 52-week lows. If you remember last week, it was pretty even. Much better this week. 267 stocks hit a 52-week high versus 104 that hit a 52-week low. How about on the NASDAQ? 3,350 stocks were up. 1,859 were down, almost 2 to 1. And check this out. New highs, 858. New lows, 256, almost 4 to 1. So the NASDAQ, of course, is tech heavy, and tech is what's driving this market. It is AI predominantly and everything surrounding AI. Last week's heat map. So we've got, and I'll show you today's heat map. Today being the day that obviously I'm recording. So for last week, Nvidia was up 3.99. Microsoft, big winner. Oracle, up 28%. Palantir, 18%. Palo Alto Networks, up big. So all of a sudden, in the software sector, this thing is flipped. Those of you that follow the markets, the ETF for software stocks is IGV, V like Victor. And you could see it was going down, 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 down based on AI disruption. Basically, AI was going to eliminate the need for software. Well, the AI companies came to the fore and said, no, we're not. We need them to be able to do what we do. All of a sudden, we got a rebound in software stocks, and some in a very big way. And then you got some of the old favorites, right? Computer hardware, Seagate Technology, up 15%. SanDisk, which has been ripping, up almost 20%. ANET, 13. Dell, who did a deal with the US, 54%. WDC, Western Digital, up 15%. So you can see there's still a fair amount of red up here, but the green, the stocks that were winners, were big winners. And we didn't have much in the way of big losers. No June swoon. So, it's really interesting. There's this old saying in our business, when you get to May, go away. And so people think that the summers are always negative, but not in 9 of the last 10 years. The market's been higher. We had a big decline in 2022, but that was understandable. What was going on in 2022? We're coming out of COVID, and all of a sudden, this 6 to 8 trillion that we had pumped into the economy was causing high levels of inflation. CPI hit 9.1%. So the Fed starts jacking up interest rates like crazy, like 0.75% a pop, meeting after meeting. And of course, the stock market took a tumble. But other than that, um, the average return for the last 10 years in June, up almost 2%. You see anything wrong with that? Me neither. So AI being a major influence on the S&P 500. So if you look at the black line, right, that has been the return on the S&P for the year up to May 29th. If you took out AI related stocks, where are we? We're actually down almost 1%. I mean, just think about that a little bit. With the AI stocks, market up 10.19%. Take them out, we're down 0.6%. AI is driving this market. So, who's doing the heavy lifting in terms of contribution to our 19% rally since March 30th? Who's responsible? Well, Alphabet, formerly Google, is responsible for 12% of the gains. Nvidia, 10% of the gains. Micron, another stock I own, 9% of the gains. Apple, another stock I own, 8% of the gains. Amazon, another stock I own, 7% of the gain. Intel, I own, 6% of the gain. Broadcom, which I don't own, probably should, 6%. AMD, 6%. Microsoft, which I own, 3%. The other, so this accounts for 69% of the lift since March 30th. The other 490 stocks account for 31%. So we are definitely in kind of a top heavy market, which is not ideal, but it is starting to broaden out a bit. Perspective on valuations. This is really important. So when we look at the consensus forward 12-month PE valuation, the PE ratio. So what is the PE ratio? The price per share of a stock divided by the earnings per share. And the average stock in the S&P 500 is currently trading at a PE of 21. But then you look at something like technology. It's trading at a forward P of 25. Personally, I think it could support 35. In other words, I could reasonably justify higher prices on stocks based on their growth rates. Now, energy, even though the prices have gone up, still 13%. I've been banging the drums here, telling people that I believe, one place that there's a whole lot of value right now, financials. So I would be, and I am personally, heavy tech, but I would also start nibbling on some of the big money center banks. They pay a nice dividend. On a relative basis, they are cheap. I think they're the next sector to go, meaning to move higher. So I like technology a lot. Industrials, with all the AI data center build out, has definitely gotten a big boost from that. But for the same PE, would I rather own an industrial or a tech? I'd rather own a tech. And why is that? Because earnings growth rates are so much greater. So, kind of an interesting perspective, don't you think? I was a little surprised when I saw that. Percentage of stocks trading above their 50-day moving average. So, we want this to be at least 50%, and it's actually 58.88% of all of the S&P 500 stocks are trading above their 50-day moving average. So we have many more stocks right now that are bullish as opposed to bearish. And you could see, this is, if we tried to draw a line at the average, for the last year, probably right in here. So we are well above that. Very positive sign. Just the beginning. I hope not. So there have been some major layoff announcements in 2026, led by Oracle. I stayed on the founder of Oracle, Larry Ellison. He owns an island that's a Hawaiian island called Lanai. He owns about 97% of that. Stay at the Four Seasons there. It's absolutely spectacular. And actually ate at a spot reserved for him. You have to make reservations to sit there. It's an ungodly amount of money, but it is a private table outside under a veranda, unobstructed view of the ocean. And you know, it's a once in a lifetime kind of a deal. Anyway, he laid off 30,000 people because, buying islands, it ain't cheap. Can't afford to have a bunch of employees sucking up your profit. But isn't it interesting that that stock's been moving up and they're canning people? Amazon laid off 16,000, Dell 11,000, and Meta 8,000. PayPal 4760, Block 4,000, Cisco 4,000, Intuit 3,000, WiseTech Global 2,000, ASML 1,700. So I think we're going to see more of this. I think companies are getting prepared for the AI fourth industrial revolution, and they're going to attempt to do more with fewer people. Why else would you be investing billions into AI? You do it so you can reduce your workforce. Manufacturing has been gaining steam in this country. So we were in negative territory the beginning of 2026. Same with February. We popped into positive territory in March and had a really nice beat in April. And I think a lot of this is probably data center. Also, there was money budgeted for infrastructure improvement. Maybe they're starting to utilize some of that, but that's good news. Market survey. Every week they do a survey of the American Association of Independent Investors, asking them where's the market going to go over the next 6 months. Historically, 37.5% will say higher, 31% will say lower. On the latest survey, 35.6% said higher, so below historical averages, but better than the previous week, where only 31.7 were bullish. How about bearish? 41.9% compared to the average of 31%. So that's up by 10%, but it's down a little bit from the previous week. So investors are feeling a little better, but they're not feeling as well as they do in a typical week. I think there's a whole lot of uncertainty out there, and I can't blame any of them for being hesitant. Now, let me show you a different picture, same kind of opinion. We call this the fear greed index. So this is done by CNN. And it is a measure that goes on a scale from 0 to 100, from extreme fear to extreme greed. And we have been locked into the greed segment for quite a while now. We're at 60. That's a really solid number. By the way, why do we care about the fear greed index? Because greed causes people to buy stock, fear causes people to what? Yeah, to sell stock. So greed is good when it comes to sentiment. You'll notice that a week ago, greed, a month ago, greed, and a year ago, greed. So maybe that would account for the fact that there's been so much institutional capital that's been put to work. Future of interest rates coming into this year, we're anticipating 2 rate cuts. Not anymore. You get oil hitting $100 a barrel, which causes inflation across the board, not just for gasoline. That's the obvious place where people look. But everything that contains petroleum products, everything that gets shipped, whether it be by ship, by semi, by airlines, if the cost of fuel goes up, cost of shipping goes up, and guess who ends up picking up the tab? The consumer. And that's why inflation has been elevated, right? We are still a long way away from a 2% rate. So there's just not a chance the Fed is going to cut rates in that environment. Now there is a greater likelihood that they will raise rates. And when are we anticipating, based on right now, the first rate increase? In December of this year. So, can that be avoided? Number one, I hope we avoid it because the stock market does not like rising interest rates. Can it handle 125 basis point rate hike? Yeah, it may pull back, 3, 4%, but it can handle that. But wouldn't it be nice if we could avoid it? And I still think there's a chance, but we would need to do a deal near term with Iran, given the fact that Trump says we're no longer talking and I don't care that we're not talking. Who knows when that's going to happen? But I've been around this long enough to know 2, 3 days from now, he could say the opposite. He could say, hey, we just had very productive conversations. Oil prices would temporarily come down and we continue to play this game. Sector performance year to date. So I predicted at the beginning of this year, I'm only reminding you because I was right. If I was wrong, you'd have never heard about it again. But I predicted that um, we would have a double-digit return on the S&P. And in spite of a war and $100 a barrel oil, we're up almost 11%. And what has been the primary catalyst of that? Earnings. Earnings were up 25% first quarter. Big winner was energy, followed by technology. Technology is up 26% year to date. We're not even halfway through the year. That is remarkable, right? You got to be on that bandwagon. Um, Industrials, materials up 10%. And it almost feels like, so what? We shouldn't be. 10% for half a year is fantastic. So the laggards are healthcare, and that's been a laggard for a year, and financials. I'm telling you, financials are going to make their move. They are. I can't tell you when exactly, but think about starting to build positions. If you don't really have the ability to um, look at the financials on different banks, and you may want to just buy the financials ETF, XLF. It's got all the banks, regionals, big money center. I prefer the big money center banks personally. JP Morgan, Goldman Sachs. Um, During my 3 day little mastermind class, we looked at SoFi, which is starting to make a move. And it's an inexpensive stock and a pretty progressive bank. That might be something that you want to consider. Again, I'm not giving you investment advice. You may want to think about that. So, what is the news of the week? What should we be paying attention to that's potentially um, market moving? So, I mentioned to you that we had on the manufacturing side A beat on both the ISM and the US manufacturing PMI. So both of those beat estimates. So manufacturing is starting to pick up. Those create fantastic jobs. Tomorrow, now it could be the same day or it could be yesterday, depending on when you watch this. But tomorrow, the job openings, the JOLTS number comes out. So it tells us how many jobs are available right now in this country. On Wednesday, we get the ADP National Employment Report. So these would be new hires. That's kind of a big deal. So you're going to want to watch for that. We also get the PMI services number. PMI is Purchasing Managers Index. So we saw the beat on the manufacturing. Now we'll see how we do on the services side. Um, we get the weekly jobs claims. These are new unemployment claims getting filed. That comes out every Thursday morning. And Friday is going to be a big day. We get the employment report, how many new jobs were created, the unemployment rate, which last time was at 4.3%. It's forecasted to be 4.3% again this time. Average hourly earnings, month over month percentage, is expected to grow 3%. Average hourly earnings, year over year, expected to grow 3.4%. So, if you're getting 3.4% raises and then you pay tax, you're probably left with 2.7. Well, that's inflation. You're not getting anywhere. So those are going to be the big reads that'll be coming out this week. So keep up with that. Let's take a look at the charts. See what we've got going on here. I'm going to pull up, for starters, the S&P 500, and then we'll take a look at a heat map. By the way, today, advancers versus decliners, even though the market was up a little bit, there were 136 more decliners than advancers on the New York Stock Exchange. On the NASDAQ, it was about even. But let's look at the SPX, see if I've got that. I'm sure I do. It's just a question of would I be better off? Well, here's the SPY, but let's put in SPX. This is a proxy for the S&P 500, which is an index consisting of 500 large cap stocks. And it's a thing of beauty. So right down here, that was the ceasefire announcement. Even though it didn't stick, but the market has gone up ever since, closed today at an all-time high. Let's take a look at the intraday chart. See how that shaped up. So we kind of started off pretty blasé, and then the market climbed. It did sell off a little bit at the end, but you know, given the headlines, the fact that we're in positive territory is damn near miraculous. The other thing I like to look at is the VIX, the volatility index or the fear index of the S&P 500, and it was actually up. So generally, if the market is up like it was today, the fear level goes down. But investors looking at these exogenous events are like, wait a second, oil's going up, potential for interest rates to go up. Um, so the fear index went up. Now it's only at 16, so it'll range from 13 to 25. And at 16, it's relatively low. So there is a sense of calm in the midst of absolute chaos out there, which is kind of crazy, but it is what it is. Again, questions, comments, you can send those to me, Steve Sitkowski at gmail.com. And I thought I'd share with you the track record, latest, greatest on our trade ideas of the week that my partner and I put out. Here, let's go to trade ideas of the week. So you can go here and learn all about the service. Here's the track record. So for this year, average return per trade. So these are the closed trades for the year. Average return's been 17.33%. Average days in a trade, 17 days. Win percentage this year is 100%. Now, I'll repeat something that I said before. We will not finish the year closing out every trade at a profit. But how many do we have here? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20. 1, 2, 3, 4, 5, 6, 7, 8. So on nearly 30 trades, we haven't had a loser yet. With all this volatility, I'd call that pretty good. How about for last year? Average return 13.69% in 27 days. We were profitable on 97% of the trades. And 2024, 15.82%. Average days in the trade 21, win percentage 92%. I don't know anybody that can boast better numbers than that. So if you're an option trader and you'd like to start receiving those trade ideas that we put out every single week, we put out the trade ideas and a video where I literally show you how you place the trade. So these are fully vetted. So you get the entry and you get the exit and or any adjustments that we make. So if you want to check that out, fantastic. If you have questions or topics you'd like me to cover, send those to Steve Sitkowski at gmail.com, and I'd be happy to accommodate. All right, been fantastic being with you. And I will be seeing you next week. So until then, be safe, be blessed, and bye for now.